I'll just go through a few of the macro things on the grain markets. Obviously, we know where we're at. Price-wise, what we've seen here this year has been much better than we had the last couple of years. So, big change in a short while. We'll go through that for just a little bit quickly. That's the question we always get for our farm marketing groups. The guys, where are prices going to be? What do you think is going to happen with the price? Should I sell now? Should I hold? That type of thing. I won't be able to tell you that for sure, but I can kind of give you some overview of some of the things that could affect that, obviously. This here is a chart from year to year. It's changed a little bit. We do have the markets off a little bit today after yesterday's report, but this is from the beginning of the year where relative performance on each commodity. And as you can see, gasoline has had, and energies have gone up the most, but we do have corn and soybeans have gone up about 6% on beans, and corn's been up 12.5% since the beginning of the year as a commodity. We're getting close to the near the end where you have to be signed up for your crop insurance. Those prices are determined as far as the coverage level in February, and then again in October as far as the average price, and whichever one's higher is the one that we'll use for that. You guys are all familiar with that. But we did see a pretty good increase in our crop insurance prices from what we had last year for sure. Corn came in at $4.58, and soybeans came in at $11.87. So, I know crop insurance prices are higher this year because of the volatility and because of the higher crop prices. But remember, you're insuring a higher priced commodity, so that investment is still a very wise investment, I believe, personally. This is another chart to see where it has been. It's a 7-year high on the corn and an 8-year high on the beans as far as insurance. And if you have any cotton, that's up as well. But no, that was on the chart that I stole. So. Ethanol, that's another big wild card right now. Obviously, we've had less gasoline usage due to the pandemic over the last 12 months. We saw a lot of ethanol plants idle. We're seeing some news now where ADM is going to start up a few of their ethanol plants in Iowa, some bigger ones again, and some other ethanol plants coming back up online due to ethanol margins finally starting to come around and maybe the economy kicking back in and whatnot. So prices of fuel have gone up, ethanol has gone up. Obviously, that's the margin. This here is how much corn we use for ethanol. You can kind of see the big effect of the pandemic last year. April was way down here. This is the gray bar is the record for the month, and the red line is this year so far, and the blue line is last year. So we've been behind last year all the way through. Now we'll probably be ahead as we go forward as we get into the comparing month over month this year. This is just another chart showing corn used for ethanol and ethanol yield. We get about 2.9 gallons per bushel of corn. We had, as you can see, the same thing there. You can see where this is by month, where we were way down last April, and we've kind of building back, but we're not where we were before the pandemic, and we might not get there, at least not for a while, because ethanol is a pretty mature market, and the economics of some of these plants, the least efficient ones, are going to have a difficulty time starting ramping back up. There's a wild card in that, though, and that is exports. Our exports have been really good. There was just an announcement this last week of 2 more cargo ships going to China. So they're not maybe importing corn or as much corn sales to them as recently here, but they have some ethanol and other products they're bringing in to, which will help shore up their supplies of their domestic corn in their country by bringing in that ethanol. So that's kind of good news for the ethanol business and maybe for the corn prices long term. Soybean usage. Soybean crush, we talked about the exports. We've had really a lot of exports, but soybean crush is another big thing to look at. And we have records on soybean crush for the last 6 months in a row. And we'll have, I think it'll continue. A couple reasons for that. Big demand for oil, soybean oil. So lots of demand for bean meal. Bean meal exports are up. But also because we've added more capacity in the U.S. due to expected exports in the last half a dozen years. There's been a couple new plants in the Dakotas, a new one in Michigan that came online this last year, and so those plants are operating at capacity and increasing the soybean crush. So that takes away more supplies domestically from our supply here in the U.S. This is corn exports, weekly exports every week. They come out with a export millions of bushels that actually get shipped. And this Monday, I guess it would have been, we had 60.8 million bushels of corn exported for the week, and we need 53.8 per week to average our for the rest of the year, to the end of the market, end of August, to get us to where we need to be for the marketing year. So we're on track to meet the USDA numbers, or maybe not above that. This is total commitments, though, as far as sales. That first one was how much is actually shipped. This is actual sales for the year. We're at 90% of what we expect to sell for the whole year already sold. Now, it's not all shipped, but for the marketing year, we're already 90%. As you can see, that's way above what we normally are for this time of year. This is last year. We didn't have our anything going on, only 30%. We ended up being lower than expectations, but any of these years, this is the highest it's been as far as the actual sales. And the biggest difference there is China. They come in and bought a lot of corn, and they weren't in there in the past. This is the inspection report just showing once again where we're well above, the red line is this year, well above the 5-year average and well above last year for sure on corn exports. That's the biggest driver in our prices. You know, we had this, the ratio in Iowa that started it, took those bushels away, but since then it's been demand driven on the export side. Soybean exports the same thing, although as you can see, we're dropping off here. Didn't have this last week, we would have been a little bit higher again. But as you can see, we get to this time of year, exports in soybeans in particular, but all exports will switch to South America. So our export inspections will start to decline. We've had a really big, robust program. Got a little delayed with this cold weather we've had a month ago or a few weeks ago. We got really frozen at the river, slowed it down, but otherwise our export on beans is getting about where it's going to be for this marketing year. And then as you can see, towards the end of the calendar year, we'll pick up again when our new crop supplies become available. Other big thing that makes the markets is the funds and the investments, speculators. This is managed money. It's just a chart to show where it is. This is net long of soybean futures and options. And we're long, this is 2020-21, so we have a pretty sizable position compared to some of these other years when we've had higher prices. So are they going to really buy a lot more from here? Maybe not at this point without another issue, but they are holding a pretty sizable long position. This is corn. Corn's even more so that way. They did have some sell-off yesterday and again this morning, and today we're selling some of these positions, but haven't changed the trend yet, but we see the speculators and the money coming out of the market just a little bit after yesterday's USDA report. Acres. How much are we going to plant here and starting here pretty soon? Estimates are over 90 million acres of corn, 94 million up as high as that, 95. But if we do that, we can't get our 90 million acres of beans we need. Combined, we should have over 90 million acres of both. It's kind of an acreage battle thing to look at here because we need a lot. Our bean stocks are really tight. We'll get into that. And then our corn inventory is getting low where we need acres of both. So we can't have as much prevent plant and those types of things this year in the U.S. as we do. It definitely would be supportive to prices. What's the weather going to do? This is a groundwater map. There's some concerns about drought, although I know we have some rain forecasts here this week that'll help us with that. Obviously no drought down here, but in Illinois and Indiana, Ohio, they've been kind of dry, and of course western Iowa has been in the news for quite a while. It's always a drought over here, so there's no corn there anyways. This is a drought monitor as of the 2nd. As you can see, we have a start of a drought right in our main area here, but there's nobody that's really excessively wet. Other than down in the south here. Western United States is really dry. Like I said, there's a good rain forecast system coming through that should help the plains and help us. This is a year ago, so you can see this year, same time, last year, same time. Last year we didn't have, as you know, it was pretty wet in the spring in some cases, so we didn't have a drought issue. Looking forward, we talked about the nice weather we've had the last few days. Next week, 6 to 10 days, valid next week, it's going to be below normal temperatures, at least that's today. It'll change by this afternoon probably in the forecast, but each day they come out with a 6 to 10 day and an 8 to 14 day forecast. And then on the precipitation probability, looks like once the system goes through, that we'll get some drier weather again that maybe follow. So we'll see if we can get in the field early or not. Other big weather, obviously, South America. 2 crops, North America, South America. Brazil's been wet here as they're trying to harvest, and they've had difficulty getting their beans harvested. I saw some pictures of beans that are sprouting in the field in the pods. It's not everywhere, obviously, but you see those type of things. And with the situation we are in a world supply, we don't want reductions. And then Argentina's been dry. So maybe look at their crop getting a little bit smaller, even though the USDA didn't change the numbers yesterday much of the South American crop. South America, if you talk to those agriculture reporting services from there, they are lowering their crop just a bit. This is talk about the slowing of harvest. This is corn harvest in Mato Grosso. This is the first corn crop. They're getting about done. They're 91% harvested, or excuse me, they're 67% harvested in some of those areas, and normally up around 91. And this is corn production. They are, even though they're going to trim this a little bit, as you can see, this is their first season corn, is the yellow. Their biggest crop is the second season corn. The reason why I bring that up on there is this later bean harvest in some of these parts of Brazil is affecting corn planting. And so they can't plant the corn until they get their beans harvested in some of those areas, and it's getting late. Their ideal planting time is by the end of February, maybe the first couple of days in March. So we're getting a couple of weeks late now on their ideal yield. And for them, their growing season is probably not going to end. They won't get a frost possibly like we'll have a concern when we get late. But it's more of, we'll be pollinating in the hottest part of the year, the driest part of the year. Their rain will slow down in the winter when they get to there, it's dry, and that can affect their yield. So interesting that with this delayed planting and not, the USDA did not change the yield yet, as the report yesterday. I think they might have to if this continues, and even what's already happened. And in the reports to come, the USDA might reduce those yields just a little bit. This is major oil seeds, all the oil seeds totals in the world, and as you can see, our stocks to use ratio is down around that 11%. That's the lowest it's been since 2011, 12 in that range, 13 since the drought. So definitely that's why the markets are up. Really quick, we'll go over the supply and demand a little bit with the USDA report yesterday. They didn't change anything. They changed soybean seed usage by 1 million bushel, reduced crush by 1 million, or domestic something by 1 million. But basically all the ending stocks from the U.S. were left unchanged. So they didn't really need to even have a report yesterday. They could have just said, look at last month. It's typical for March not to have a lot of changes, but with everything going on with the exports and whatnot, we thought maybe there would be, a lot of people thought maybe there would be a little bit of a reduction in carryout. And that's, I think, it didn't happen yesterday in the reaction, but today we're seeing that, a little bit of that fund money coming out in the market trading. Just before I came on here, I think beans were down 25 and corn was down 14. So this is another chart of just the report. You can see the changes are zero basically. I mean, they had a little bit here in feed and residual, but they made it back up in food and ethanol. So the net change was zero. Left the farm price, and it's over here. I mean, left the farm price the same at $4.30 a bushel for average farm price. All the thing about this chart up is you can see even with if we have 93 million acres, this is RJ O'Brien's, one of the brokerage firms we work with, their estimates, even with 93 million acres and a good yield of 178, which would be an all-time record, we still only have a carryout of about 1.5 billion this next year for 2021-22. So this might not be a one-year thing. I mean, obviously we can get even better yield and plant even more acres, but we're looking for good demand to continue to stay for more than 1 year here. This is, I know they're going to talk about this later in the presentation, but this is seasonals for corn. I just wanted to show you what it's kind of not the same as it used to be, because this has got now the renewable fuel standard and ethanol, and that's changed these seasonalities, but still you have one time to sell here by the end of March. You'll see the market kind of start to decline, and then by the end of June, still in corn, that's kind of the best time to have your forward contracts and your grain marketed. After that, it kind of goes down on the seasonal scale. Soybeans, real quick, same thing, no changes, basically nothing. That's where they had that 1 million in seed and less in residual, so basically no changes in soybeans. Once again, people are looking for a little bit less carryout. Can't do a whole lot because their carryout's at 120 million, and I would say somewhere around that 100 to 110 million is the lowest it can go. That's all that can be left in the pipeline. Same thing here, with 90 million acres of beans, and we get 51 bushel yield, which is going to be close to a record. We did have a little better a few years back. But even with that, we're only taking a carryout from 120 to 154 as far as estimated. So still a 3.4% carryout to use ratio. And you can go all the way back, other than in 2014, 15, and around there hasn't been too many. We're still going to be very tight on beans, is what I'm trying to say. So I think it's more than a 1 year thing. Doesn't say we have to go a lot higher from here, but we should have well-supported prices for more than 1 year. Seasonals on beans are not near as easy to come up with. They're a little bit later though. You look at July and the end of June, July, same thing. You'll see where it starts to drop, but the marketing on beans is a little bit later in the season as far as the seasons generally. That's partly because of the demand side coming in year round. We have 2 crops. Wheat doesn't matter, just put that in there. They didn't change wheat either. So, but one thing on the wheat to look at, we're talking about supply and demand, or carryout to use ratio on corn, we're at 10%, and beans were at 3%, but wheat were 37 to 35%. We're trying to get it down low enough where it's reasonable, because it's been pretty high, 50% plus for several years. And how we've been doing that is we just haven't planned it. The U.S. really is not competitive in the main wheats, hard wheat, soft wheat in the world market. Some of our specialty wheats, yes, we use that domestically. But on the wheat side of things, there's lots of places to get wheat in the world. Everybody grows wheat. So we're going to concentrate on corn and beans. This is just a chart showing corn, how it tracked in 2008. It's kind of similar. I mean, maybe we're in this blip right here, right now, where we're going down, but it bounced back up and traded over. That year is really close, as you can see. So if it stays on that trend, we traded over $6 into this planting season that year. So we'll have to see how planting goes, but if we get any flips in there, I'm not necessarily predicting this, but I think $6 is definitely not that far away. It's not out of the question on the board. And this is soybeans in other tight years, other tight carryout years like this. And this is where we're tracking so far. As you can see, other years where the carryout use ratio is actually even higher than we are now. We had prices much higher. This is 2012 in the drought, where we got way up in the upper teens there. But even if you look at the year after 13, 11, we are still higher on that. This is November beans now, not the cash beans. But we're still higher than we are now. So I wouldn't rule out a $13 to $14 November bean price if we get any type of issue with planting at all this year. I'm saying that if they hold out for that, maybe put some floor protection in, we'll talk about that, but definitely potential for higher prices in beans than we are today based on historicals. China, I just threw this in here because I was at a presentation that we did internally at Premier a couple of weeks ago. We talked about China and their big influence and their hog herd. They had that African swine fever. They decimated the herd. They said it was going to take 3 years for we get back. Well, here it's about a year and a half later, and they're almost getting back to levels where they're at. And as you can see, this is the number of million head that China has, 310 million, US 78 million. So quite a bit larger than anybody else in the world. They like to eat pork over there. There's a lot of people to feed. Thus, lots of corn to buy and bean meal. And how did they grow their herd? It wasn't necessarily internally, but they have increased what they imported was live swine, and that's all breeding stock, sows and boars to get their hog herd up. So just one reason that is huge feed consumption is the reason why it's driving their big demand for corn. Then, of course, we all know the one last thing that's affecting our markets and affecting everybody's lives, not in a good way. Hopefully, we're getting through the end of this as we move forward here, but it's the coronavirus pandemic. A year ago, we had a meeting and we were talking about, oh, this maybe won't last that long. Obviously, that was wrong for sure. But hopefully, now that we got the vaccines out there and we get things going, that we can get through that and we don't have to talk about it any longer. I went really fast because that's my MO. I rattle on 100 miles an hour. So if you got any questions at any time, you can ask me afterwards. I'll be around, or the group next presentations as well.
Pointers there. Like Doug said, I'm Eddie Hannigan, for those of you who don't know me, but I sit in the office in Royal. I've been there about 3 years. I'm starting my 4th year this month, and Ron Hizzard started me 1984, so I finally made my way up to Premier. The NBE, no basis established contract. you establish your futures on this one. You know, it doesn't really say that. You think it's a basis thing, NBE, but you establish your futures on whatever month you want to go to. It leaves the bases wide open. You normally like the futures, and you set them, and then you don't like the bases, you're waiting for them to narrow up. And that's why you do one of these. It's a pretty good contract. It's been around a really long time, too. But the bases can also go the other way. They don't always have to narrow. You know, you're thinking they're going to narrow up, and they might not, so it could go against you. What I was thinking also with an NBE, you got the future set. So with that said, you know, you're just sitting there with the future set, you like them, but there might be something come up in the world, something changing in the prices. I was thinking about this, we could throw a call at that. And you can make it a minimum price contract. And still no basis set against it, but you'd be an NBE with a call, minimum price contract. So it's really something nobody ever looks at, the old NBEs. You used to call them heads to arrives, but we call them NBEs. They're just a contract you don't really look at a lot. A few of you in here probably trade them. I know a couple up front here, we trade them at Royal, but they're kind of forgotten a little bit, and that's why I kind of want to touch base on it some. They do have a cost. You can see your costs here, guys, gals. 0 to 11's 3, 0 to 11's 5 on the beans, and so forth on the other months. You'd be looking at those right now for your new crop, and so forth. But the best benefit on this for you guys would be the bases. If you're wanting the bases better, then you like the futures, set your futures, wait for the bases, for one thing. When Doug got here the first time, he made the switch on all our fees for these, and he made them more attractive and a little bit more competitive, but that's about the first thing Doug looked at when he got here. Yeah, you can see that they're not bad if you look around at any other facilities, companies, we're probably about right in line with our fees. Futures, knowing when to price, you know, you kind of look right in there. June, July, right before July, good pricing time to set your futures if you're looking at doing a NBE. A little bit beforehand, you look at your 30-year, your 15-year, your 5-year, and so forth. You can kind of see when you might want to price, when you could, a good time to do it. And once again, you got to set your basis sometime before harvest. And looks like about right in harvest is about where they're at. You got 19, 22, and 19, except Ocnove. And looks like a pretty good time to set them all in all on the corn. Soybeans, you kind of see it pretty erratic there for the 30, 15, and 5. Pretty much you can see, I would say you probably get Brazil and Argentina in there a little bit, making that erratic as it is. But still, your June, July is a pretty good slot in there once again for setting them. And then for setting your bases, July, August, September is also a pretty good time to set them on getting at a price contract is all. But that's all the slides I got.
I'm going to cover today our NBEs and historical futures and basis, and look at some different pricing windows. Here's a look at the basis values for Tolono and Sydney historically over the last 10 years. We see the November, October, September timeframe. That's where our basis has typically become the narrowest. Right now, Tolono and Sydney basis for fall is about 2,500. You see, we have got down to 1,900, 2,200 has been about the average. Do an NBE, costs you 3 cents. We're right about there right now. I have a feeling that once we get closer to harvest, we're going to see these basis values start to narrow up because we don't have such a big carry like we have had the last couple of years. We're going to have a very small carry going into this crop. I think the market's going to call for that grain to come to the elevator and harvest, and it's going to do that by narrowing up that basis for us. Historical basis values for Toronto and Sydney on beans shows us the best time to set the basis for fall is in July, August, September. Those values are much narrower in August and September. Historically, where we're at right now is about 3,000, and that's pretty common, right? But again, with beans, I have a good feeling that by the time we get closer to harvest, the market's really going to be calling for us to bring those beans in during harvest this time, not put them in the bin. It's going to give us that signal by shrinking up that basis.
Kind of what I'm going to go over is, ROIs or, profitability per acre, and then some of our specialty contracts that, that we really started offering about 1.5 years, 2 years ago now. And just, they're not for everyone, but for some people, they're a nice tool. So starting off, just diving into ROI and profitability, just looking at corn on where we are on the current market right now. We use $725 an acre as expenses. We know some guys that's going to be a little higher, some guys that's going to be a little lower. It just depends on input costs, your cost of rent the land and everything like that. So we're currently looking at about 200 bushel an acre, just trying to stay a little conservative there. I know a lot of guys use that number. And then if we're going 450, which I don't know what the market's doing today, I haven't had a chance to look, but if we're going 450 to $200 an acre, that's going to be about 24% return on investment. If you're comparing that to something like the S&P 500, that usually gets about 10 to 11% a year. So it's kind of showing what your investment in your farm is getting this year. It's good levels. It'd be about $175 profit per acre if you just start pricing right now. We know not everyone's going to price everything right now. We got a long way to go, a lot of growing season left, but it's a good price point to get a start at, or at least think about it. And then just beans, similar story to corn. Good levels to start pricing out if you haven't priced much out yet, or if you haven't priced any out. If we use $550 an acre for expenses. Yet again, higher or lower depending on each individual farm. But that would, if we're using 60 bushel an acre and about $12, cash price for that. That puts us around 31% return on investment. Yet again, if you're comparing to something like the S&P 500, which is 10 to 11%, that's pretty strong returns, and that's about $170 per acre. We haven't seen values like that, profit per acre, for quite some time. So I wouldn't be too greedy. I think we all think the market's going to go up a little bit more, but now's not a bad time to really start thinking about pricing. Next, I'm going to just kind of go into some of our different contracts that we're offering, both OTC and then the minimum price contract, which is this one on this slide, also known as the guaranteed price contract. There's several different names for it, but basically the functionality of this is it allows the producer to set a floor underneath them while also having the potential to partake in the upside improvement on the market. There's two different ways you can go about it. The first one is you can do it by selling your grain to the elevator, so selling cash today and then buying a call back on the board. That's a popular way to go about it, or you can just basically buy a put, and then when you execute it all, it'll all work out. I have two examples. One uses the call, one uses the put. The first one I'm going to walk through is the call. So let's say this is off yesterday's number, and I did round down just for ease of math purposes. If you sold corn at 475 futures, bought a 490 callback for 50 or 45 cents against the Dees, the minimum price you would get would be that 475 minus the 45 cents minus the 25-cent basis. Let's just say we're setting it that day minus the 2-cent fee. That puts you a floor price at 403. Now, where you would make money on this if the market just rallies up hard, we go above that 490 price, and then you'll start getting a little bit of return on that call. And like I said, if you are interested in that, because I know it's kind of hard for you guys, especially in the back, to see those numbers, but And then the put version of it is you just buy a 480 put. It's going to cost you 50 cents, and the math for that would be 480 futures is your guaranteed floor, and then you get the 50-cent cost of the put, 25-cent basis, 2-cent service fee. That puts you at 403 as well. So end result's the same, just two different ways of going about it. Next is some of our OTC programs. There's some pros and cons to these, some expenses, I guess. The first one I want to talk about is the accumulating min-max. Kind of the basic functionality of that is it sets a floor, which is that bottom green line, and then it sets a ceiling, which is the top blue line. Your ceiling on this in particular one is right around 550, and your floor is right around 450. Each day you're going to price out bushels, so it kind of functions like a daily average futures contract. So you sign up 1,000 bushels. If you're on for 100 days, you sell 10 bushels a day at whatever the settlement price is for that day. The main cost of that is just cost you 11 cents, but there's no double up risk on it or anything like that. And then if the guy wanted to take the top end, if he just wanted to set a floor, but he thought the market was just going to rally hard, we can take that top off. It is going to make it a little bit more expensive, but it's still a good tool if you're really bullish on this market. The next look, another one for corn. It's our no knockout accumulator. It's one of our more basic ones. It's kind of the one when we first showed to you guys. It's the one we show. Not necessarily the most popular. It's not necessarily the least popular. It's just kind of an easy one to understand. So you have a double up level and a knockout level on these. The double up level is the upper green level. The knockout is the bottom blue level. On this particular one, your knockout is at 432 and your double up is at 540. So kind of the functionality of that is if you're in between the 432 and the 540, you're going to receive 540 for that day's futures price. If you're, for some reason, fall below that 432, you're going to knock out the remainder of those bushels are going to be freed up. And then if you happen to, on expiration, which I have a full expiration until end of November, you're going to receive the 540, and then it's going to be double the amount if you're above that 540 futures on expiration date. Now, I will say this last year, these weren't the most attractive just because we started putting a lot of these in at low levels, right around that 350 range. And then we all saw what happened in the market. We just continued to rally and rally and rally, and it ended up hurting a little bit on the double up. And that's where we could take that double up off, but it's going to take a little bit off that top end. You won't be receiving quite as big a range. And then just look at the soybean version of these. The accumulating min-max, like I said, it kind of functions. You price out every day. You have your floor and your ceiling. You're going to be somewhere in between that range at the end of it. You're going to have an average futures price. It's going to cost you about 12 cents. You're going to have a ceiling about $13.20 and a floor about at a $12 strike price. Yet again, those are good values. If we happen to hit the ceiling, at least you're hitting the ceiling at $13.20. Now we could always take that ceiling off. It's going to cost more. And then the knockout accumulator for the beans, we have a floor or a knockout at $11.83 and a double up at $13.70. So if we double up at $13.70, if you're referring back to the ROI or profitability per acre, that's a strong number to be doubled up at. But yet again, we could do some tweaking with this. We could also do one where we take out the knockout and set a floor up underneath it. It's going to, lower that top value down a little bit, but it guarantees you have, a certain amount of price now. And that's kind of all I had.
Mine won't be very long, but one of the things that we do, so my background, I came from retail, ag, for about 8-9 years before this, 10 years, somewhere there. So I kind of attached to the input side a little bit too. So one of the things that I do is track kind of ratio relationships. We all know inputs are going up, going through the roof. If we could get our supplier to sell us multi-years out, we would be all over it, right, with some opportunities. Inputs, NPK, that's kind of difficult, just the way that market works today. But the one opportunity, there's diesel fuel. We know diesel fuel is going up. Garrett's going to discuss that after a while. But if you look at some of those programs and some opportunities, in that $12 bean range, right? If we can sell some $12 beans in some of those programs, turn around and lock in diesel fuel for 22 at today's current levels, I think we'd all agree they're probably not going to be here again next year, as they just continue to keep climbing over $3 now. That's an opportunity. Some of that corn, we're trading corn in the upper $4 on some of those programs. That's, looking back through time, if we think about what was fuel prices when we had upper $4 corn and $12 beans last time, right? Is that some opportunity to back that? So, and as we sit down and make those input decisions, we all know potash has been a great buy, right, for many years. We can go through the agronomic side of, do we want to put that out on the ground multi-years at a time, nutrient tie-up, nutrient leaching, luxury consumption, those types of things? Or can we come up with a way to lock in some prices, lock in some sales, and back-to-back those things over time? Phosphates, they're just kind of traveling trend line. That price is going to follow the nitrogen market pretty close. Nitrogen's skyrocketing. I know there's been some guys saying $250 a ton higher than they got it on last fall. Pretty astronomical. Fertilizers, I've heard some prices on the phosphates upward of $150 a ton higher to $200 a ton higher than last fall. Something to be mindful of going forward next year. So do we have some opportunities to hedge that stuff off, make some sales, and back those things? That's kind of all I had. And like I said, the fuel component is very interesting. But that, like I said, that's an opportunity, I think, to look at, selling some grain for 22. Yes, this price could go higher, but we could grow 92 million acres of corn, 90 million acres of beans, and be sitting here in a completely different situation, and fuel still wanting to take off on us too. So do we have some opportunity to back those ratio values that are extremely good historically? The green highlighted boxes, that's a snippet of a 10-year track, and I've highlighted the best top 10%. So anything you see green box, we're coming out of a historically good ratio of grain prices to input costs. So fuel, we know we're kind of taking off out of that now. It's pretty obvious.
I'm Garrett Bruns. I think I know pretty much everybody in here. I've been with Premier about 8 years, if you don't know who I am. I run the fuel side of what we do at Premier. We do have a fuel company, I guess. We're pretty much known for grain, but we do sell fuel also. We sell Cenex branded fuel. Cenex is a part of CHS, which is one of the largest co-ops in the world. Largest seller of premium diesel fuel in the United States. When you buy fuel on the road, it's not going to be a premium. What we do is we've got injectors on the trucks in that side cabinet. It's injected at the farm level, so you're getting 3 to 5% efficiency, better than just regular diesel fuel. You're getting stabilizers, more lubricity on top of that, so it is probably one of the best products out there when it comes to diesel fuel. We do have 4 trucks, 2 out of Apex or Tolono, 2 out of Elliott up north. We've got 3 plants now. We're moving about between 4.5 and 5 million gallons a year. 8 years ago when we started, when I started, I guess, we've grown a lot. We've went from about 800,000 gallons a year to about 4.5, 5 million. We should finish off this year. So we've changed a lot in what we're doing. We do bulk def, package def, oil, bulk oils. A lot of guys in here do use Cenex oil. Cenex oil comes with a warranty program. If you go buy a new combine today or a new tractor, you do have a warranty with that, right? Cenex's oil will actually extend that 10 years, 10,000 hours for a new piece of machinery, 8 years, 8,000 hours for a used, as long as it falls within the guidelines. The only requirement, I think it's $400 up front. It's pretty cheap insurance when it's all said and done, but they do require you to take oil samples. What that oil sample is doing is setting a trend line for that piece of equipment. So if they see an elevated amount of copper, any elevated amount of metal basically in that sample, they're going to let you know so that you can fix it prior to it becoming a disaster. Other than that, they do cover the entire cost of the repair and the labor on that extended warranty. I think we gave you guys a check 2 years ago. You guys had a failure on something, and I think Matt and I passed over the big check that day and shook hands. So, again, that's just who we are, what we do. When it's all said and done, I'm just going to run through charts. This is basically looking at crude all the way back to 2016. Here's COVID. I think we're going to be range bound this year when it comes to crude. I think we're going to stay in this $55 to $65 level unless some outside things happen. They blow something up in the Middle East. That can happen really easily. The one side of it is we're not necessarily staying with fundamentals. If you look here, last week, there was a drone strike or whatever it was, and the market actually went down. If that's ever happened in the past, we went the other way. So we're not following normals anymore. But since the beginning of the year, we've continued our rally. I think we're going to trade between 60 and 65 for a while. Excuse me. The crazy thing is we're going to get an EIA report here today. I think we're probably going to see a build on crude, and we're going to see a draw on refined products. The one thing that's changed right now with us as a country, fracking got kicked out of the mix, right? So they're coming back in at these levels because they're profitable. At this point in time, I think they're going to stay running and stay profitable because I think this is where we're going to trade for the rest of the year. One thing locally is Chicago market is what we're based off of on pricing. Just Chicago basis right now on diesel fuel is about 8 3/4 cents. As a group, though, it's about 19. So all the pipelines that we're feeding our market are going to the Gulf now because they can pick up an extra 14 cents to send us out. So just something to keep an eye on. Our basis gets kind of crazy. Usually doesn't start till about April, but it's kind of already started. This is just the chart from the beginning of the year. If you go back, we started at $47 a barrel. We're just kind of pushing that. 65 is going to be the top end right now. If it pushes through 65, I think you're going to see 70, 75 very easily. I don't know if we're going to push through it. I personally don't feel like we're going to. I had a guy call yesterday, said he's kind of worried we're going to have $6 gas. I don't see that happening right now, but there's always a chance. So this is just the seasonal chart. I went all the way back to 17. It's probably hard to see. All I'm trying to actually kind of reiterate here is here's COVID, right? This has given us an opportunity, and that's going to be the same when you go over to heating oil, right? You definitely know that this is last year. Here's where we're at currently. So we're coming in, and I think we're going to probably have an average year. If you go over the last 5 years and look at an average price for diesel fuel, everything's been right at $2. Whether even if you add in last year, it's $2. If you throw last year out, you're about 2 1/4 for your base price for your diesel fuel. So at this point in time, at these levels, like Tanner made the comment, it does make sense to lock your fuel in. We started out the year, let's call it December. We've went almost 50 cents up since then. So if you were able to lock your fuel in prior, you probably did the right thing. We still have contract available. We also went out to 2022, which is something we don't normally do. But looking at these charts and looking at what the averages are, we've got prices basically all the way out in 2022 that are only 10 to 12 cents above where we are today. So that might be an opportunity at least to take a position on your fuel. If you're looking at 10,000 annual consumption, I would take a position of at least 4,000 because then at least you know you can be profitable at these levels. So here's gas. Gas did the same thing when it comes to the trends. You're going to see gas this year from the pumps. $3 plus, I would say, is probably going to be the number. We don't sell a lot of gas. It's all bought at the stations because Costco and Sam's still have their war going on, so they're about 40, 50 cents cheaper than we are. So I'm definitely going to recommend if you need gas here in Champaign to go there. There was one time here about a month ago, they were selling at about a 10-cent loss. And I don't know if that was just to pull the people from Costco, from Sam's, or what they were doing, but it was a 10-cent loss from what their rack was, but they must make a lot of money inside when it comes to their food and everything else. This is a headline that I pulled out this morning. Volvo has stated that they're going to be fully electric by 2030. Okay? So they're going to look to remove cars with traditional combustion engines, including hybrids, by the end of this decade. They're really pushing this idea. I think we all know we're probably not going to have electric tractors by the end of the decade. Maybe we will. Maybe I just don't have the sight or the vision to see it. But this is a push that all the manufacturers are kind of pushing for. I have a hard time believing that we're going to get rid of gas and diesel engines by the end of the decade. But it was funny that Volvo came out and actually threw that out there. So I'm going to throw that up there, but I do have a couple things. Illinois, Pritzker has just put a bill on the Senate floor that, if passed, going forward, there's a sales tax incentive right now for biodiesels. You don't pay sales tax on it. If this passes after, once it goes through, that sales tax advantage is gone. So there will be no difference from buying a B11 compared to a straight diesel fuel. The difference is going to be that this bill mandates 5% biodiesel in all the diesel sold in the state. Iowa has a push right now. They're doing the exact same thing. I know there are, and I'm going to say, misconceptions for a lot of guys that don't like biodiesel. The one thing that we do that might be different to our competitors, we've got underground soy tanks at our plants. We will not haul any bio that is not, it's called BQS 9000, that is not a certified product. We will not pull anything from a terminal. We will not pull any bio products from somewhere else. We do it because we are supporting soybean oil, because we are a co-op, and that is one difference that might be set us apart when it comes to the rest of our competition. So if it does go into effect, it's July 1st, 2021. If he gets it passed, the comment made is that he's going to take the $107 million, which would be the difference between that sales tax. Basically, it's an incentive to buy. But that $107 million is going to be part of the shortfall that we have in the state of Illinois. So that's fun. But it would be 5% on every gallon of diesel sold. So just a heads up. And I didn't have anything to do with that. So neither did Premier. I know there's a lot of guys that really hate biodiesel. So we do about 50%. Half of our bio, or half of our fuels are bio, half of them are straight fuels. As of right now, short term, refineries are still having issues due to the cold snap. They're not used to being down under 30 degrees down south. That is why we are shipping a lot of our stuff in the pipeline down there right now. Again, that group basis is kind of going crazy right now. The other thing to watch short term is going to be there's an upcoming OPEC meeting. That might give us a little bit of reprieve here. If they come out and say that they're not going to pull any fuel back or pull any production back on crude, that we might actually see it, I don't know, retract about 15 cents. I think that's going to be about the max that we're going to see out of it. Other than that, that's all the good news I had for you. You guys have any questions or comments on that? So, is everybody against the biodiesel side of it if they're going to push it? Yeah? So what do? You call your legislator? Yeah. See, that's the difference though. And Iowa, the only benefit we have here is we actually have the infrastructure to support what they're doing. Iowa does not sell biodiesel really in any way, shape, or form other than it's on the road at gas stations or truck stops. Here we can at least support it, make sure that you guys do have a quality supply of diesel fuel still. They're reeling right now in Iowa. So.
We're going to have a short presentation now from Tim with Main Street Data. We have a product called Market Vision. If you haven't heard of it, Tim's going to walk you through it. It's a pretty excellent product, and we'll let Tim tell you that.
Okay, thanks, Darren. So as Darren says, my name is Tim Davis. I'm the VP of Sales for a company called Main Street Data. I'll talk about that more in a little bit. I'd like to thank Jessica and Doug, whoever set up the schedule, because I am now between you and lunch. So that's not a good place to be. Only thing that'll be worse in the ag industry is between you and happy hour. That's really a bad spot to be if you're in the speaking realm of things. But I'm fairly local, over by Petersburg, Menard County is where I grew up, family farm. I've spent a lot of years in the ag industry, primarily in the grain business. Worked for Continental Grain, who was then bought by Cargill around 2000. And then I went and spent some time managing sales for GSI, grain bins, grain dryers. Spent a couple of years launching a precision agronomy company. And I was lucky to find Main Street Data here about 2 years ago as an up-and-coming ag data science type company. And let's talk about, whoops, I always do this. Talk about who is Main Street Data and why is Tim Davis standing in front of you and why did Premier become a partner of ours. So we're an ag data science company based in Kansas City. We're founded about 4 years ago. We're a legacy business from a company called Machinery Link. Machinery Link leased combines from about, 2006 to 2017 across the country. We'll talk about how that plays into what we're able to offer today. We are not a normal ag data company. Most ag data companies are coming on your farm, collecting data, then analyzing it, and giving you back and your agronomist back information to help you make better decisions. We've already collected our data, and I'll talk about that in just a minute. But we are in that ilk. We've got our data collected. And because we have our data collected, we have the largest yield data set in the country. We have 7 million acres that was collected over an 8-year period, over 26 states. And that's when those combines were running through Machinery Link. And I'll show you the map and I'll talk about how that was all collected here in just a second. So what do? Our goal is to provide risk intelligence to the ag industry by providing solutions and proprietary market intel to improve decision making. We're a risk intelligence business, not a risk management business. So the definition of that would be Premier is a risk management business, right? They're helping you make decisions. Our job is to give Premier better intel to help you make better decisions. So that's sort of the line that we work through. These are sort of our pillars, and I just explained risk intelligence, which is the most important pillar on there. We've talked about partnership, we've talked about data science, and a lot of our products end up being software solutions. So the solution that drives all of our individual products is that we built a data refinery out of that data set that was collected during the Machinery Link days. And basically, it's the missing link between just gathering data or extracting value from it. Okay? A lot of growers that I talk to say that they're data rich but information poor. They can't get enough information out of the data. That's getting better and better all the time. I don't say that to slam any industry. It's just the collection of the data is there, but the figuring out what to do with the data to get the most out of it is obviously being updated all the time as we move through season to season. So this is a little map of 1 year of the combines running across the U.S. So what happened is that this company got started because, as you guys well know, a combine is a pretty expensive item. And it sits in your shed 90% of the time. I guess 92% of the time if you want to get exact. And so why not set up a combine leasing business that ran south to north following the crops and create some value for growers and have a business that's profitable? Well, on paper, that business sounds perfect. But Mother Nature has something to say about when you're done with the combine and when you can move it to the next customer. And that always caused issues. They had to add to the fleet, and that caused them not to be profitable. It wasn't a business that was losing a lot of money, but it wasn't making any money either. But my boss, our current CEO today, Ron LeMay, has a background from the telecommunications industry. He retired in 2003 as the president of Sprint Communications, and then got into ag and has a passion for ag now, getting close to 20 years. He knew the power of data. He knew where this industry would go because the telecommunications industry had already been through the data change. And so the idea was let's turn these combines into collection devices, right? So they actually probably built the first puck or CAN plug or whatever the names are for the devices now that you plug into the CAN bus and pulls the information off the combines. And they did that. They created a modem. They were able to collect the information, right? But then you got to have accurate information. And so the first year, they really didn't understand calibration and all the harshness that's out there in the environment when you're running a combine, and they had to throw away 75% of their data. Well, they quickly then said, if we want to keep doing this, we've got to invest. And so they actually put calibration teams into the country. They were able to manage more of the calibrations from the modems inside the combine. And from then on, the data they collected was like 98% of the data they collected was actionable. There was no way they were going to go through this whole process and then have data that wasn't accurate. That would not be good. So the data was collected by us. It was curated by us, and we believe it's the most actionable and accurate data set that there is in the country. So this is just a few details. 7 million acres collected. They collected a yield every second, every 150 square foot that the combine was running. Obviously made sure there was calibration in place. And then we worked with IBM, and IBM gives us 20 years of weather history, both before the data set was collected and after. And by combining the data set results with soil type information and 20 years of weather history, you can do some incredible things in terms of data science and data analytics. So what are those incredible things that we do? Well, we focus in 3 areas right now. We have a crop forecasting. Where is my jiggy here? Oh, there it is. So we work in 3 areas right now in terms of solution buckets. We have a very robust crop forecasting product that Premier is actually a customer of, and we'll talk through some of that here in just a second. And we have a grain marketing platform called Market Vision that I'm actually going to demo for you guys here before we get done. This is value to the grower and then value back to the farm marketer so that they can work better with you because the numbers are in place and you guys can talk about them a lot easier. And then we do some stuff in the agronomy world around yield benchmarking that we won't talk about today. And then we're the type of company that's always looking for the next mousetrap, right? How do we continue to improve our products? How do we get feedback from our customers and our prospects as to what's the next tool that we can build? So let's talk about a little bit about our yield forecasting tool. And I only show you this because it's also part of the grain marketing tool. And I want you to understand how we forecast yield. So first off, we are different than most any other yield forecasting company. Most yield forecasting companies that you might hear on the radio, they came out with a national yield number today, or you might read in the paper or Farm Magazine, all use satellite imagery, right? They use NDVI imagery. It's the reflection of the chlorophyll in the crop. And that's an okay way to forecast, but the one problem with it is it's not accurate until early to mid-August. Before that, it's pretty much, well, this is what it says, and we're going to adjust based on other factors. So we don't do satellite imagery. We use our data set to give us a start in every county, and then we use the weather, forecast and actual weather, tied to the crop stage that the crop is in at the time. So I also don't have to tell you guys that it certainly matters the stage of the crop, depending on when it's hot, when it's cold, when you have precip, when you don't, right? Dry Junes are okay, as long as we get rain in July, those types of things. So we use a weather-based forecasting model tied to the crop stage, which makes us different. And in general, different is good as long as you're accurate. A couple things that we have that are proprietary to us. We have a view of water capacity. So what can the soil hold from a water standpoint? Once you know that, and you know precip levels past and forecasted and actual, you can actually make some really sharp adjustments to your yield forecast. And then secondly is, where is leaching prominent, right? Where do we lose nutrients if we get a lot of rain? Obviously, it's no surprise that the Mississippi, following the river down here, Memphis area, etc., a lot of porous soils. But some people will be surprised that this area has some significant leaching. A large area up in here in the north central Iowa, south central Minnesota area that has a lot of leaching. We were actually working with the co-op here in the 19 crop. And if you remember 19, lots of rain, right? They were pretty impressed with our ability to forecast their yields given all the rain that they had. And we would not have been accurate if we didn't have this data and this adjustment into our model. So this is what the model looks like, right? If you have access to it, it's a county level forecast. So we forecast every county in the Corn Belt twice a day. We roll those counties up to the state rolls up to the nation. So we're a bottoms up forecast. If there's a 2-inch rain that comes right through here, right, it covers 50, 75 counties, you can bet our national yield's going to change. Because that's a big enough adjustment, all those counties clicking up, rolls up to the state, rolls up to the nation. So we're a very transparent forecasting company. Most of the satellite companies just say, well, national yield went from 175 to 178 because there was rain in the need, or something like that, right? You can actually look exactly detailed as to why our adjustments were made, which most people like. Very interactive. You can just click on a county and see where our forecast is. We also do soil moisture levels. Doug had some weather maps up here. This was as of last August, so we were starting to get dry as we were getting into harvest, if you guys remember that. This was our soil moisture map in August, looking at October. Dry, dry, dry. We got very dry during harvest, at least in most parts of the country. Creating this huge drought out here in the Southwest. That's been sitting there for a couple of years now. However, we also use IBM's 6-month forecast to look at what we're forecasting soil moisture levels to be as we move forward. And here is what the forecast is. This was actually last week's data, but I doubt it's changed very much. This is the soil moisture forecast at the end of April. So we've got rain coming in this week. We do not expect the dryness to start to creep in. If I had time, I would show you the summer maps. It does show temperatures a little higher than normal, and it does show soil moisture just at an adequate level, nothing surplus like this map shows. But again, their forecasts are 3 or 4 or 5 months out, so they can't change. But it doesn't appear like we're looking at any type of drought conditions going into this current year. So how do we make these adjustments? We adjust for 10 factors in every county every day, and they're things like planting progress early, late, excessive moisture or not enough moisture during planting to tassel to reproduction. It looks like this if you actually look at a county level view. And so these are Iowa counties, and this is actually 2019. I like to use this slide. I probably have to stop using it because it's 2 years old now. But I like 19 because we had all the swings, right? We had bad weather early, and then we got good at the latter part of the crop. And so if you look at Allen McKee County here, on August 5th, we had a trend for Allen McKee at 194. On August 5th, we were forecasting it at 181. Why were we down 14 bushels? Well, here's all those 10 bonus and penalties. Think about this filling in as we go through the growing season. And so right off the bat, we knocked a chunk off because of late planting. We knocked a huge amount off because of way too much moisture leading up to tassel. But we added a big chunk on the back end because weather was perfect during tassel, no frost issues, good grain fill. And so consequently, if you'd add up all of those bonus and penalties, it would be minus 14 bushels. And that's how we get to the 180. I'm not trying to go into too much detail for you. I'm just trying to have you understand the level of detail that we go to create these forecasts. So then everybody wants to talk about accuracy. So you do all this, because are you accurate, right? If you're not accurate, then it's a waste of time. Our goal is to be within 4% of the final yield on July 4th. And we've been able to hit that. This is a 10-year error rate chart. And so we have been at 4% on July the 4th, but then the next 30 days through July and into early August, we're down here in sub 2% accuracy. So we're talking bushel and a half either way of the final yield. If you know bushel and a half either way of the final yield right in here, you can make a lot of good decisions, right? You can make good decisions about grain marketing. You can make good decisions about, what you're going to handle if it's premier. You can make good decisions about truck needs and labor. And there's just a whole bunch of stuff that the industry can benefit from. And then this is the USDA, right? Well, the USDA comes out every 30 days. And when they come out, what? The information is 2 weeks old or 3 weeks old from the survey that they collected 2 or 3 weeks later. So our level of accuracy and the level that we can update this every single year really plays big during this time frame. And this is really what we hang our hat on from a forecasting standpoint. In the end, we believe the USDA gets it right. They really do, most of the time. But they really struggle in the May, June, and July time frame. And that's our advantage as a company. Soybeans, I think I have soybeans on here. Yeah, 3% on July 4th, which always seems weird to me. You'd think they'd be less accurate on soybeans because, they're a later maturing crop. But that's what the data says. 3% on soybeans on July 4th and getting close to 1% accuracy by the time we get to the 1st of August. So, any questions on the forecasting, on data collection methods, anything like that? Okay. Well, next I'm going to move in to our grain marketing product that I think will be very interesting to most of you. Whoops, my link's on here, isn't it? Oh, there it is. Okay. So what is Market Vision? It's a digital farm management tool that helps you optimize grain trading products. Right? I'm guessing, I haven't met a farmer yet, and like I said, my dad's retired. We farmed, and I have a lot of good friends that are farmers, and I've met a lot of farmers in 30 years in this business. I've never found one that didn't say, I want to improve my grain marketing. And if you ask them what's their weakness, they always say grain marketing. Generally, getting more out of my precision ag, might start to slide up that scale. But grain marketing is still where everybody wants to improve. And so Main Street Data set out to build a tool that could do that. It uses our crop forecasting expertise that I just talked about and the weather that we have from IBM. And then it's a combination of our proprietary data and IBM's data and public information that allows us to do this. I'm going to go into a demo here, and so a picture's worth 1,000 words. But what it's trying to do is it's trying to paint a picture of what's going on with your farm. I kind of call it a health check of your farm, so to speak, from a revenue standpoint and from a profitability standpoint. I'm just going to go into the demo. So this is a software product, but if you're nervous about computers or software, you don't really have to worry about it in this case. Number one, you've got the farm marketing team at Premier to help you. And then once you have it set up, there's really no work to do after that. So let me change this to 21. Okay, we're good to go now. Okay, so this is our market page. And what we're doing here is we're using our view of U.S. crop size, which can be substantially different than USDA's. Our view of demand, which may be slightly different than USDA's. Plus other world supply and demand elements, other things that move the markets are all tied in to an algorithm. And then we use data analytics and we create these really simple to see sell and hold signals, right? So if we're in a green area, which this is these futures, right? So we have been chugging along here on this massive rally of about $1 or over $1 a bushel since the crop year began in September 1st. And these green areas are sell opportunities. These blue and orange areas are hold opportunities. And so just looking at the data, right? There's no human, nobody has an opinion here, right? It's just simply crunching millions of data elements every single day to create these sell and hold windows. So, this has been a runaway bull market, so we haven't had a lot of hold opportunities. We've had 3 so far. But the idea here is to use this as another tool, right? You're not going to stop working with Premier. If you have a broker, you're not going to stop working with the broker. you're going to use this as another tool, as a data tool to say, yeah, this is a good time to pull the trigger based on the data. So it's really simple. Green is the sell window. Orange or red is a hold window. Now, notice we're not saying sell on this day and sell this much this way, right? That's an advisory service that might cost $4, $5, $6 an acre. Our price is very, very economical, way less than that. So we're just using the data to supply these windows. You'll also up here pick your best delivery point, right? So, if it's an ethanol plant or a premier location or wherever is the best delivery point. This is my farm over in Menard County that I'm demoing. I do that so no one can put me in jail for sharing someone's data that I don't have legal right to do. And so these would all be around central Illinois, but they're listed in best basis level down. So it's a good way to figure out where is my best market. Once you choose that market, then it's going to pull it up in here. So my best market is a river market right now for fall at 9 under 476 harvest price. That'd be last night's price, okay? And then that gives me where I can sell my next bushels at. If I haven't sold any, that's my first sell level. If I've sold 20%, I want to sell more, that is where I repeat it. So this gets updated every day. And then down here is a little value piece. Darren was up there talking about MBE contracts and knowing your basis levels. Well, whatever delivery point you set, this maroon line is the 3-year average basis for that facility for whatever day you're on. And then if the basis is better, like it is right now, it's shaded in green. It tells you the difference between current basis and 3-year average basis. So if you're going to utilize those MBEs, this is a good tool to have to know whether and talk about when you want to set that basis. So this is the market page. It just gives you an indication of when to pull the trigger and when to not. That's usually the trouble with growers is when do I pull the trigger? This helps make that a little easier. And then the other page that's equally as valuable is the dashboard page. This is where we utilize our crop forecasting. So there's a little work you have to do here. Your farm marketer can help you do this. You simply enter in your counties and the acres that you farm in the county and what you would expect the yield to be for those acres, normal yield, right? And you do that very simply. It's a very simple process. You just go into this map, you find your county, you click on it. Once you're in your county, you simply enter in your planted acres the upcoming season and what you think that average yield is going to be, and it's in. Literally, you can do it in 15 minutes if you know your acres that you farm in each county. It's not a hard onboarding process. We tried to make this as simple as possible so that you can get the value out of the product. Once we do that, then we're going to start forecasting your production, just like I showed you how we do it for the progressive weather yield product. We're going to forecast in your counties and show if your production is growing or shrinking. I'll jump back to the 20 crop real quick to show you what happened there. So in the 2 counties that we farm in, Menard and Cass, I had put a 207 yield and a 205 yield. Throughout the growing season, we're getting updates. It can update every day. It doesn't always change every day, but it can update every day. We ended up at 223 and 217. So my anticipated production is moving with the forecast. Well, why is that important? Well, that's important in terms of your percent sold. The only thing you have to do in season is enter your contracts as you make sales. That's the only piece of information that you have to keep up once you get into the growing season. You simply put your sales in, and then that is going to give me an accurate percent sold, moving with my crop, right? People get worried about getting oversold. This protects against that. The other issue that causes more loss of money is you don't get sold enough early on. The chart showed the highs in March and then again in July. And yes, this past year is not a good example of that. I certainly understand we had an incredible rally that happened in August and still going on today. But everything kind of fit in the right place for that to happen. China's corn appetite, USDA having bullish reports and those types of things. But I've been around long enough to know that we're not going to have a dollar rally from August to December. every year that we farm. If we do, you don't need me or this program. But that's just not realistic. And so what we do is we keep your percent sold with your crop size. So let's say you want to be 50% sold by tassel. Well, you might be 50% sold at 200, but your crop's 230. You're not 50% sold anymore, right? And the easiest way I can explain this is I would rather know that I've got those extra 15, 20, 30 bushels in July than to wait to have a good surprise in October. Always want more bushels, right? Never turn away bushels, but I've lost decision-making opportunities. If the surprise happens in October, what am I going to do with those bushels in most years? Store them, DP them, sell them at a price that I'm not happy with. This helps you make those decisions earlier on those bushels. Does that make sense to everybody? Okay? And then the other thing we're doing then is we're creating this profitability, hypothetical profitability update. So the only other thing that you have to put in, you got to put in your counties, your acres, and your yield, 15, 20 minutes, and you got to stick in your gross cost per acre. Now for 21, I took my costs up. I did this like 2 months ago. I took them up to 800. I wanted to make sure that I was at the high end of the range. Some of you will be much lower than that. But even at $800 an acre, and this is over in the central Illinois area, I'm looking right now at a projected profit of $186 an acre on my corn acres, right? And that's doing that because it's taking this 800, dividing it by anticipated production, gives me my break-even levels. A lot of you may figure break-even levels on a spreadsheet or by hand. This does it for you, and it's updating every day with your crop size. Your break-even will go down if your crop gets bigger, right? So that's all happening. And then we simply take, we know the product's around 30% sold right now for 21 based on the sell signals. I know what I've sold this at. I look at that market that I set on the market page that said the 900 price, 476, whatever it was. The product hypothetically sells the other 69% of my crop at that price, and it says if I sold everything out today, I'd sell for 460 on average, and that's what creates this revenue number of $186 an acre, and a total on this 1,360 acres of $254,000. So this is going to update for you automatically. You don't have to do a thing, right? And what I like about this page is it's doing what is happening in real life. What's happening in real life? Every day. It's July 10th. My crop's getting bigger or small. Yes? It's capturing that. Futures levels are going up and down. Capturing that. Basis levels are changing. Capturing that. My best market will change. I have to go manually do that, but I can go do that, right? If my costs go up or down, I just make a simple change in my costs. It's capturing real life and giving you a view of where you sit. This will help you and your farm marketers make better informed decisions. No one can predict what the board does. Right, there isn't a single person on August 1st of this past year that would have said corn's going to $5 and been right? Somebody could have said it, but nobody expected that, right? All you can do is put yourself in the best position to make an informed decision. Well, how can you do that? Knowing what your numbers look like, right? I mean, same thing with the ROI numbers that Darren or somebody had up on the screen. What's my return on investment, right? This helps you see that. And so this plus the ebb and flows of the technical analysis of the hold and sell signals also gives you that peace of mind as to when to pull the trigger, right? So that's pretty much what it does. There's some other tabs on here that I'm not going to go into. But I've been looking for a program like this my whole career. I've been on a lot of farms. I've helped a lot of guys make good decisions, some bad, but mostly good. But I never could paint the full picture. I never could see the whole farm. So now, if you guys are working with your farm marketers, you guys can sit down to this information simultaneously and start to have those really good conversations that can lead to great decisions. And I really believe that's going to help that conversation, right? I mean, marketing's hard. I really believe that selling 5 or 10% of your crop at one time is probably one of the hardest decisions in business, across all businesses. Mostly because it's probably just not affecting your livelihood, right? You got brothers and other family members. If you're the guy in charge of grain marketing for your farm, that's a tough place to be, right? Or maybe you huddle up and make decisions together. That's the other thing that's done. I have a large farm that's using this, and they have weekly meetings on Monday morning. They put this page up. So everybody in the farm knows what's going on, right? It opens up those that communication from a decision-making standpoint. So, any questions about how we do this or why we think it's valuable? I mean, we're so happy to be with Premier and having them bring this product to you guys. The one thing that I would ask is that if I piqued your interest at all in any of this, meet with your farm marketer and take a harder look at it. There's a 30-day free trial that's offered with this, so you got no risk. Put your acres in, take a look at it for 2 or 3 weeks, let them know if you want to continue it or not. And I told you the price is very economical. This is a $200 a month program, right? I mean, in any size operation, that's not much of an expense. Your payback is selling 10,000 bushels, 25 cents better, which you'll do that and then some with this type of information at your fingertips. So, anything else? If not, I'm done, and you guys can have lunch. Thank you very much.
I got a question.
Yeah.
You said you were getting information from the combines from Machinery Link in 2017.
Yep.
Where are you getting the data from then on?
Great question. So, we have a technological advancement in our model, like 2-3% a year, that handles that technology boost. But in reality, and this is our data science team talking, the innovations and the increase in yield have came a lot from population increases, especially in corn. You know, hybrids are better, of course, and all that's getting better and better, and precision agronomy is getting better. We have plans next year to go out and add data to our data set, but we have back tests to check our accuracy. Obviously, there's a way to back test our forecast. There's a way to back test our percentiles too. We can roll up every farm in the county to 50th percentile and then compare it to the USDA yield for that county. That's our check to make sure that we're still accurate. The data science team that looked at the data set said, you've got enough years, you've been across a drought, you've been across great weather years, you're fine for the foreseeable future in terms of accuracy. And then we just up it a little bit because of technology. Great question. Anything else? All right, guys, thank you.